Chapter 11. In this chapter, we're going to learn about how to build a really high performing portfolio of stocks with lowest volatility or lowest risk. And so, for that, we will learn the seven concepts of correlation, covariance, Sharpe ratio, beta, tangent portfolio, capital asset pricing model, and cost of capital. So, if we learn these concepts, then we can actually build a portfolio. So, let's understand what is a correlation. To understand correlation, let's take an example. Hours that you study for an exam and the exam grade that you get. If you see a correlation between these two, that means that hey, if you increase the hours studied, you get better grade. Then you can say this is correlated. So in Excel, you can very quickly find out correlation between two samples. This is an independent sample, exam grade. So it goes first, y1 to yn. And x1 to xn is the hour study, which is a dependent sample. So if you use correlation.s, you can very quickly get a number that's between -1 and +1, which basically says, hey, it moves in an opposite direction. If you say, hey, if you study more, it doesn't matter, you'll actually get worse grades, then the correlation will be -1. But if you study more, if you get really high grades, then you get a correlation close to +1. Correlation of 0, it means doesn't matter how much you study, you're not going to get good grades. So that was an example of correlation. But how does that apply to the stock market? So let's say Tesla stock performance. Let's say this is the closing price of Tesla, $600, 620, 579. Then look at closing price of S&P 500 or a VOO, which is a proxy of S&P 500 movement. Then you look at its closing price. Very quickly you can say, hey, what's the correlation between these two? And you can find out the same way like we did earlier between hours studied and grade received. Similarly, what is the correlation between Tesla stock price performance and S&P 500 performance? Well, correlation.s in Excel is an easy way, but a harder way, let's say you want to do it manually and you want to understand how correlation actually works. And the first way is you find out the average return for individual stock. Then you find out the volatility, which is standard deviation, which you find out from percentage change for a given day. And then you do standard deviation for that entire year. If you're looking at 1 year's of data, and then you multiply it by square root 252, you get a yearly standard deviation. From average returns, from average volatility, you can get the deviation from the mean, right? So you, for a given stock return, look at its deviation from the mean, and then you sum all of that up, you get deviation from the mean. That's useful for finding out covariance. Covariance between two stocks is 1 upon t minus 1, which is number of samples minus 1, and sum of deviations from the mean. So if you find sum of deviations from the mean, you can get covariance. From covariance, you can actually get correlation. Covariance upon standard deviation of the two stocks gives you correlation. So that's a harder 5-step way in which you can calculate the same thing that Excel does in one quick formula. So use Excel. But once you do that, you can, but the key thing to remember in Excel, if you want to use this, you have to use the data pack. You have to turn on the data pack in the data section. And you can even do this not just for 2 stocks, but for, let's say you have 50 stocks, and you can build a correlation metrics using Excel, using Excel data pack. But if you did it manually, it'll be too tiresome. So yeah, once you do that, you can get individual correlations. You can actually find out variance for the entire portfolio. So that's why you can say, hey, if my portfolio returns 10%, but if the volatility is 20%, then that's the risk return that you get. So volatility or variance is an important metric. So let's make it even more practical. Let's take two stocks, Coke and Intel. Intel gives you 26% return with a 50% volatility, meaning it goes up and down in a given year by 50%, and in a given year it gives you 26%. Coke, on the other hand, has much lower volatility, almost half, and gives you a 6% return. So if we have to look at these two stocks and say, hey, what percentage should I put in Intel, what percent should I put in Coke, right? Coke gives me better risk protection. Intel gives me better return. So given your return and risk, how do you get the best return for a given unit of risk that you take on? So for that, let's plot what it looks like. So if you go 100% on Coke, you get this, right? Remember this piece is 6% return, 25% volatility, 50% volatility, and close to 26% return. So if you go 100% on Coke, this is what your return profile would be. If you go 100% on Intel, this is what you'll be. So if you change your percentage allocation, this is the yellow line that you get, right? So, and I've showed that here, 100% Coke is here, 40% Coke, 60% Intel, 60% Coke will give you this, and then 100% Intel will give you this, right? So your volatility changes as your return changes, as you change the weight on this yellow line, and you get this yellow line. So this yellow line is set of all portfolios that you can get just by two stocks, Coke and Intel. So within that yellow line, there are three sections. Section 1 and Section 3, which are the Section 1 and Section 3. These are inefficient zones, meaning you're taking on more risk than the return you're getting. Versus this section here, in between, number 2, is the efficient zone, where you're actually maximizing the return for the unit of risk that you take. So it's best to optimize for expected return. And once you have a reference expected risk-free rate, let's say 4% is what you get from a government bond. Today it's like close to 0% for treasury bills, but you should find out what is risk-free rate. Risk-free rate is like treasury, government bond, or something that rarely goes down, right? Once you get the risk-free rate, you can actually draw a tangent to this yellow line, which actually just touches at the maximum peak. Remember, higher this green line is better, because you're getting more return for the risk that you take. The steeper this green line is better, right? So the steepest that you can get for a two combination portfolio is this tangent portfolio. A tangent portfolio is a portfolio where you have the maximum return for each unit of risk that you take. So this tangent portfolio is, you can calculate for using two stocks, like what is the best return I can get for the risk that I'm taking. And that you can do using the risk-free rate, right? Similarly, so now we saw that, hey, if these two stocks were perfectly correlated, then this yellow curve wouldn't be this way, it'll actually be this blue line. And so the more uncorrelated stocks that you get, you can actually reduce the volatility and increase the risk. So that's the key insight here, meaning if you go up north to the west, you get better performance. And so correlation is actually bad. If you have stocks in your portfolio that are all correlated, then you're actually not reducing the return. You're not reducing the volatility, you're increasing the volatility and reducing your return for the volatility that you take on. So the key learning why we need to understand correlation for portfolio building is so that we can find stocks that are not correlated, so that we can actually start going northwest. So that's the key insight. So for example, if to this two stock portfolio of Coke and Intel, if I were to add Microsoft, or if I were to add Johnson & Johnson, this curve will further go to the left, right? The yellow line becomes the blue line. So that means that my tangent initially was this, now becomes this. So I just got a steeper curve. So when I get a steeper curve, I'm getting more return on the y-axis, right? Because if you see this, the return is much larger for the risk that I'm taking, versus here the return is slightly lower. So it's all about how much return you get for the risk that you're taking on. So now you can imagine that, hey, if you keep adding 10 stocks, 20 stocks, if you keep adding, you'll constantly be optimizing and going to northwest. So you'll have to add stocks in such a way that they're not correlated. And so this section 2, which we saw earlier, right? This is the efficient frontier, which is basically a set of all portfolios, and you can plot any points here, which are efficient. And here, this yellow and red line is basically shorting. You're actually negative on Coke. You can go below and take money. You can sell Coke now and then use that money to invest in Intel. So that's when you get this negative. And you can even go higher than 100% Intel by borrowing money from Coke or selling something else. So the efficient frontier set of portfolios that you can all invest in. And that's on this green line. So related to that is this concept of Sharpe ratio, right? So this curve, right, that starts on the risk-free rate, goes and touches the tangent portfolio. The line that is at the tangent is the line which has the highest slope, right? So it has the steepest slope, right? So the highest Sharpe ratio is the tangent. When you have to plot the tangent, meaning one of those data points which you can actually use to invest in, that's your Sharpe ratio. But intuitively, Sharpe ratio is your rise over run. So what is rise is this, the return that you're getting over the run, which is this volatility that you're taking on, which is the expected return minus the risk-free rate. So if you see, this is the expected return minus the risk-free rate divided by standard deviation or the volatility that you increase. So rise over run, that's the Sharpe ratio. And so you want to look at the tangent, which is the highest Sharpe ratio, and which basically says, hey, this is the best return I can get. So higher the Sharpe ratio, the better, right? Lower the correlation, the better, right? Because then they don't move together in the same direction. Stocks that have higher correlation move together in the same direction. So the stock market falls, everything falls, and it actually accelerates your fall. So you want things that are not correlated. So if we were to draw that line that is a tangent portfolio, you can imagine that you can invest in this 100% in this risky asset, and in that case, you should get for this risk return. But you can also say, hey, I don't want to be fully invested in stocks or a risky asset. I want something here, where I'm invested some portion of my tangent portfolio, but I'm also having investment in risk free. Or you could say, hey, I want to actually short my stock and my risk-free rate, and then I want to actually go long, right? So that gives you a way to actually go long here. So this blue line is the capital market line. So that's the key. You can invest in any of these portfolios and still make the best return for the risk that you take on. And the final concept is this CAPM, which is the capital asset model, which helps us with this concept of cost of capital, which basically says, hey, for a given company, what is the return that it should be making? And if let's say Johnson & Johnson were to ask $100 for an investment, Microsoft were to ask for the same investment, what would the expectation be of the investor? So that's CAPM. So we'll get into an example, but there are three assumptions that the capital asset pricing model has. The first is that markets are efficient, meaning people buy and sell. There's no taxes, there's no transaction fees. Ideally, it's too strong of an assumption because there are taxes, there are spread fees, which is basically the buying and seller. There's a spread difference, so you actually end up paying more when you're buying and getting less when you're selling. So there are some sort of fees involved. Investors are all holding efficient portfolios, meaning the blue line that we saw, everyone wants to and is rational and hold efficient portfolios, and they all have homogeneous expectation. They all have most of the information, and they all have the same information. So with that, we can prove that efficient portfolio is equal to the market portfolio. So a market portfolio is basically the stock market, the market index, right? So how? We know that the demand for equity is, if under these three assumptions, is that everyone wants efficient portfolio. We just saw that everyone is rational and then they expect efficient portfolio. And what's the supply? The supply is like the market of all companies out there. And we know that at any given point, demand and supply matches, because at any given point, someone's holding the stock. So if we demand and supply match, we are saying efficient portfolio is a market portfolio. So if we do that, we can actually build this concept of cost of capital using capital asset pricing model. So what is cost of capital in real example? Let's look at that. So cost of capital, it helps us with this return expectation, which says RI, the return that I expect from a stocks equals risk-free rate plus beta times the market return minus the risk-free return, which is the risk premium of a given security. So let's take a concrete example. Let's say Tesla has a beta of 1.25 and Microsoft has a beta of 0.5. We just saw how we can calculate beta from correlation right? And so higher the correlation, higher the beta, right? So lower the correlation, lower the beta. So in this case, Microsoft has, this is dummy numbers, they're not real numbers, but let's assume that Microsoft has a beta of 0.5 and Tesla has a beta of 1.25. And again, to quickly recap, beta is basically measuring the commonality of co-movement with the market. So if the market goes up by 1%, we are saying Microsoft will go up by 0.5%, meaning they both, the amount of common risk that Microsoft has with the stock market is 50% of what it is. It's very low. Versus Tesla is 1.25, meaning if the market goes up by 1%, Tesla will go up by 1.25%, right? And vice versa. So if Tesla has a beta of 1.25, Microsoft has a beta of 0.5, and risk-free rate, let's say, is 4%, and market on an average gives you 10%, then you can actually calculate what is the expected return or the cost of capital for Tesla and expected return or cost of capital for Microsoft. Meaning, if with these beta, if Microsoft were to raise money for a project, and for the same amount of money for the same project, if Tesla were to raise money, how much would the investors expect? That is cost of capital. That concept is cost of capital. So with this formula, in Tesla, investors would expect 11.5% because it has a higher beta. Microsoft investors would expect them to make 7%. So this is important, that for a given project, it's easier to fund in Microsoft compared to Tesla, because you now have to make more money for the same investment because of higher beta, because your movement with the market, common risk with the market is high. So for the same investment, investors expect higher return from Tesla compared to Microsoft with these beta numbers, right? So if we now were to plot this return of beta versus expected return, which we just saw, then beta of 1 is the market portfolio, and Microsoft would be lower here, expect lower beta, lower return expectation, whereas Tesla would be higher return and higher beta, right? So that line, this red line, is the security market line, which basically for every stock you can plot them. Where do they fall? Below or above the market? If it's below the market, it's lower beta, lower correlation, better investment with the return expectation that you have. So the reason why beta is important to calculate is once you know the beta of individual stocks, you can actually calculate the beta of your entire portfolio by just weighted average summation of the weight of your given stock and its beta with the market. And if you just sum all of that up, you'll get the beta of your entire portfolio. Lower the beta, the better. It measures, again, beta measures the common risk with the market portfolio. Right? I have given an example. I did this calculation, which I think will be very helpful for you as well. If you want to calculate beta, I have put in a link in the description of this video to this Google Sheet file that you can actually copy. So if you see, I have calculated the beta of PayPal here, right? I've calculated the beta of PayPal for the last 1 year. This is as of July 2021. It's 1.41. And we also can see the correlation, and if you can actually see how I have made this calculation in the Excel. But beta of stock is standard deviation of stock, correlation stock with the market, and standard deviation of the market. Similarly, what I also did was I calculated beta of Johnson & Johnson, which sees 0.5 versus PayPal is 1.4. So check out the Excel file. It gives you a very easy way to calculate beta of a stock, and then you find out beta of all of your stocks, and then you find out beta of your portfolio. And see if you can optimize percentage weight that you provide in your percentage weight of a given stock that you hold in your portfolio such that you're minimizing beta. So you can again use Excel solver to minimize beta. It'll give you the weights that you should use for every portfolio, every stock. So I can create another video if that's helpful on how to calculate and minimize the beta of your portfolio. So hopefully you can calculate beta of one stock for all of your stocks, and then calculate beta of your portfolio. And then using Excel solver, we can actually reduce beta and make Excel give us the weights as to what percentage weight I should put in PayPal, what percent I should put in Johnson & Johnson. So that's the practical aspect of this session, where you can actually use these concepts of correlation, covariance, security market line, tangent portfolio, beta, to actually build a portfolio where there is lowest beta and highest return. So to quickly recap, there are some mathematical aspects of this chapter that I'll quickly summarize now, which is expected return is sum of weight versus expected return of a given entity. So for a given portfolio, if you want to find out the expected return, you just sum up the weighted average of the weights of the portfolio stock that you have and the return that each one of them gives you. And volatility of a two stock portfolio, we just saw Coke and we saw Coke below and we saw Intel, right? So that's the weighted average example. So if you want to find out the volatility of two stock portfolio, volatility again is risk, right? We saw in the previous chapter. The risk is you can find that out using beta, but you can find out beta using correlation. You can find correlation using covariance. So let's say how do we find out covariance? Covariance of two stocks is expected return and standard deviation, expected return of the stock subtracted by the expected return. And if you sum all of that up, you get covariance. Covariance is return of a given stock minus the expected return. And if you do that for every stock, and if you sum all of the deviations up, you get covariance. And you can also calculate that by the historical average of historical mean. Ri bar, Rj bar are the averages. When you do that, you can get covariance. Within covariance, and you have standard deviation, you can get correlation. Again, you don't need to do all of this. You don't need to understand all of this math, but you can do this all in Excel in a very quick way that I shared at the very start of the video. Once you do that, you once you have the correlation, once you have the covariance, you can find the variance of the portfolio for, let's say, a two stock portfolio, then the weight of that portfolio, variance of that return, weight of the second portfolio squared, variance of the second return, and plus 2 times the two weights times covariance, right? And covariance can be converted to correlation, as we saw earlier here. And similarly, in large portfolio, you'd have to do it in a much complex way. But you can do all of this in Excel in a very easy way. And I'll create another video for that. Risk and return. Choosing an efficient portfolio is very important. We saw how choosing a portfolio that gives you the highest return for the risk that you take is very important. And you do that by choosing any portfolio in the efficient frontier. And when you diversify or add stocks, we saw how you go northwest, right, in the earlier part of this video, and your portfolio improves, volatility reduces, performance improves. And all investors, based on their risk appetite, they should be investing in an efficient portfolio to reduce volatility, increase risk. Short selling, we saw that as well. Negative weightage allows you to borrow money and then invest for the ones that you feel is higher return. Even like buying a house is actually, you're shorting the bond market, which you're trying to say, hey, the house is better investment, so I'm going to borrow 5 times the money that I need. I'm going to put 20% down, 80% I'm going to borrow. So you're actually shorting the treasury or the fixed income in favor of the house market. So you're saying, hey, this bond market will be poor performance, and so you're actually shorting. So you're leveraging up. So when you're leveraging up, it's also called leverage investing. Buying a house is leverage investing. It's also called margin investing. You can do that same thing even in stocks. So we also saw how we can get the cost of capital, right? Which is basically risk-free rate plus the market premium. And so for every company, there's going to be a risky investment and a risk-free investment, right? And so cost of capital helps you to find out for a given company what percentage return can I expect. Expected return is the risk-free rate times the weight invested in the risky investment times the market premium, which is expected market return minus the risk-free rate. The other concept we went through is a Sharpe ratio. Remember rise over run, which is basically, this is the rise and this is the run. Expected return minus the risk-free rate of the portfolio divided by standard deviation of the rate of return of the portfolio. So highest Sharpe ratio is the tangent. So we'd want to choose a portfolio that gives you the highest return for the risk that you take on. And beta, we can calculate from covariance by this formula. Beta is equal to standard deviation of that stock multiplied by correlation of that stock with the portfolio divided by the standard deviation of the portfolio's return. So once you calculate beta, you can actually find out beta of a stock. You can find out, in this case, the beta of one stock, and you can find out beta of the entire portfolio as we saw earlier. And this is the required return. If you want to add a stock to your portfolio, the required return it should provide is the risk-free rate times plus beta times the market premium. So if the required return is 4% and the expected return is 8%, that means that your portfolio is actually a good investment and help you improve your Sharpe ratio. So that's the summary of chapter 11. We learned practically very quickly at the very beginning how to build beta, how to build of a given portfolio. We learned how to do that from correlation, covariance. We improved the Sharpe ratio, and we built a tangent portfolio, and we also looked at what is cost of capital in a sense and in a very practical way. All right, thanks.